In the midst of so much talks about the new tax law, did you know that some incomes are actually tax-free under the new law? Yes, you may not be paying taxes on certain earnings, but it is only if you know where to look. Hello everyone, welcome back again to Excel with Ugo. In today's video, we'll be looking at what the government will not be taxing in the new tax law with reference to the tax reform bill. So you need to know that the new tax law is not just about the government collecting more money, but it's also about making the system fairer. That's why the new law clearly lists what will not be taxed so that low and middle income earners, retirees, and small businesses will breathe a little more easier. According to Section 163 of the Nigerian Tax Act and the 50 tax exemptions and reliefs published on the Fiscal Policy and Reforms website, the new tax law introduces several reliefs and exemptions designed to protect low-income earners, average taxpayers, and small businesses. I'll only be speaking on a few of them and talk more on others when I do their own specific videos. I will drop the link to the document in the description box so that you can have access to it as well. Under the personal income tax or payee section, first, individuals earning the national minimum wage or less will not pay personal income tax. Second, individuals earning annual gross income up to 1.2 million naira, translating to about 800,000 naira taxable income, will also not pay tax. Now, this 1.2 million naira is what we call gross income, and this is very important to note that gross income is not the same as taxable income. Let me explain this simply and show you how it works in Excel. Assume this is a salary breakdown structure of a worker who earns 1.2 million naira per year, which is 100,000 naira per month. That 1.2 million naira is the gross income, meaning total earnings before any deductions. Under the new law, you do not start charging tax on gross income immediately. Before tax is applied, the law allows certain statutory deductions to be removed from the salary. Only what is left after these deductions is called taxable income. Some of the key allowable deductions include pension contribution to PFA, National Health Insurance Scheme, National Housing Fund contributions, interest on loans for owner-occupied residential housing, life insurance or annuity premiums, rent relief, which is 20% of annual rent, subject to a maximum of 500,000 naira. Let me quickly explain the rent relief because many people find this confusing. Rent relief is 20% of the annual rent paid, but it is capped at 500,000 naira. So if your annual rent is 500,000 naira, 20% is 100,000 naira. If your rent is 2 million naira, 20% is 400,000 naira. If your rent is 2.5 million naira, 20% is 500,000 naira. But even if your rent is 5 million naira, the relief cannot exceed 500,000 naira. That cap is very important. Now back to our example. For a worker earning 1.2 million naira annually, pension contribution at 8% of his basic housing and transport comes to 96,000 naira. NHIS contribution at 5% of his basic salary is 24,000 naira, while NHF contribution at 2.5% of his basic is 12,000 naira. For this example, let's assume that the staff does not have a life insurance premium and he pays an annual rent of 500,000 naira, which qualifies for a rent relief of 100,000 naira and still within the maximum limits allowed by law. So when we put all the deductions together, the pension, NHIS, NHF, and rent relief, the total allowable deductions come to 232,000 naira. And once we deduct these 232,000 naira from the gross income of 1.2 million naira, what we are left with is the taxable income, which is 968,000 naira. Now, this is where the new tax band comes in. Under the new tax law, the first 800,000 naira of taxable income is taxed at 0%, meaning it is completely tax-free. So from the 968,000 naira taxable income, the first 800,000 naira is not taxed at all. That leaves a balance of 168,000 naira. This remaining 168,000 naira is then taxed at the next tax rate, which is 15%. So the tax payable becomes 168,000 naira times 15%, which is 25,200 naira. This means that even though the person earns 1.2 million naira per year, the actual tax paid for the entire year is only 25,200 naira. That works out to an effective tax rate of about 2.6%, which clearly shows how the new tax law protects low-income earners. And this is exactly why it's very important to understand the difference between gross income and taxable income. The third relief we need to talk about is the one that says reduced payee tax for individuals earning annual gross income of up to 20 million naira. Now, you need to understand that this relief is not a total tax exemption. It simply means you will still pay tax, but you will pay less tax under the new law than you would have paid under the old law. So if your annual income falls between 1.2 million naira and 20 million naira, the new tax system is more favorable to you. The reduction comes from adjusted tax bands and lower effective tax rate. Let's take an example to make this clear. Assume a staff earns 20 million naira per year as salary, which comes to 1.6 million naira every month. For this comparison, let's say there's no pension contribution, no NHIS, no NHF, and no insurance premium. To keep things simple, under the new tax law, we will apply only rent relief using the maximum allowed. And under the old tax law, we will apply only the consolidated relief allowance. Remember that the CRA has been abolished and no longer applies under the new law. Under the old law, the CRA was high, and this resulted in a lower taxable income of 15.8 million naira. Whilst under the new law, only rent relief applies, and it results in a higher taxable income of 19.5 million naira. At this point, many people assume the new law is worse, but this is where the new tax bands make the difference. Even though the taxable income is higher under the new law, the tax rates applied are lower and more progressive. So under the new law, the effective tax rate comes to 18.08%. Whilst under the old law, despite having a lower taxable income, the effective tax rate is still higher because of tighter tax bands. This means that the total tax paid under the new law is less than what was paid under the old law, even at 20 million naira annual income. And this is exactly what reduced payee tax for incomes up to 20 million naira means. Moving on to other tax exempt items. Gifts are not taxable. Pensions and gratuities are also tax exempt. Pension funds and assets under the Pension Reform Act are tax exempt. Any retirement benefits granted in line with the Pension Reform Act are tax-free. Compensation for loss of employment up to 50 million naira are also tax-free. Next, about the capital gains tax exemptions. Under the new tax law, first, the sale of an owner-occupied house is not taxed. What does this mean? So this is your own house, the one you personally live in, and not a rental property, not a property that you use for commercial purpose or you earn money from, but your own home. And it is only when you sell such property that you will be exempted from capital gains tax. But note that if you sell a house or a property for commercial purpose, or not specifically your own home, such tax exemption will not apply to you. Personal effects or chattels worth up to 5 million naira are not taxable. Sale of up to 2 private vehicles in a year is also exempt from capital gains tax. Gains on shares below 150 million naira per year or gains up to 10 million naira. Let me explain this because this is where many people get confused. Under the new law, capital gains tax will not apply if either of these conditions is met. 1. the total value of shares sold in a year is 150 million naira or less, or the total gain from shares sold is 10 million naira or less. Let's break this down with examples. Example A. Assume you sold shares worth 120 million naira in a year and your total gain from the sale is 25 million naira. Even though your gain is above 10 million naira, you will not be taxed because the total value of shares sold is below 150 million naira. Example B. Now assume you sold shares worth 200 million naira and your total gain is 8 million naira. Even though the share value exceeds 150 million naira, you are still not taxed because your gain is below 10 million naira. But if you sold shares worth 200 million naira and your gain is 25 million naira, in this case, as in example C, the share value is above 150 million naira and the gain is above 10 million naira. So the exemption no longer applies and capital gains tax will be charged. Now the next relief builds on this, that even when your gains exceed the exemption threshold, capital gains tax will still not apply if the proceeds are reinvested. Therefore, if you sell shares and normally would have paid capital gains tax, but you reinvest the proceeds, then the gains on those reinvested proceeds will not be taxed. It is very important to know that proceeds means the total amount received from selling the shares. That is the original cost of those shares plus the profits. So proceeds is not the same as gain. Moving on, charities and religious institutions are also tax exempt. Under the company income tax sections, small companies are exempt from tax, and a company qualifies as a small company only if these two conditions are met. The company has an annual turnover of less than 100 million naira and a total fixed assets of less than 250 million naira. If one condition is not met, the company does not qualify. Moving on, eligible or labeled startups are also tax exempt. When the law talks about an eligible or labeled startup, it does not mean every new business. Rather, it means a company that has been officially approved by the government under the Nigeria Startup Act and given a startup label, meaning that without that label, you cannot enjoy the tax exemptions meant for startups. The next is compensation relief, which allows companies to claim an additional 50% deduction for salary increases, wage awards, or transport subsidies given to low-income workers. A better way to properly understand this relief is by looking at Section 163, subsection 3 of the Nigerian Tax Act, paying particular attention to 3A. The Act says that a company shall be entitled to an additional deduction of 50% in the relevant years of assessment in respect of costs incurred in any 2 calendar years from 2023 to 2025, based on wage awards, salary increases, transportation allowance, or transport subsidy granted to a low-income worker, which bring the gross monthly remuneration of the worker up to an amount not exceeding 100,000 naira. Provided that any additional award or salary increase to an employee earning above 100,000 naira as monthly salary shall not qualify for the additional deduction under this subsection. In simple terms, this section introduces tax incentive for companies, allowing them to deduct more than they actually spent when calculating taxable profits. When the law says that a company shall be entitled to an additional deduction of 50% in the relevant years of assessment in respect of costs incurred in any 2 calendar years from 2023 to 2025, it means that it only applies within a limited time window and it only applies to specific costs. In the aspect of time limitation, when it says that costs must be incurred in any 2 calendar years between 2023 and 2025, it means that it could either be 2023 and 2024, or 2024 and 2025, or 2023 and 2025. That is, you only get it for 2 years and not all 3 years. The second question to answer is, which costs qualify for this incentive? The law says wage awards, salary increases, transportation allowance, or transport subsidy to low-income workers. Emphasis on low-income workers. The reason why it is structured this way is because the government wants to recognize and reward companies that between 2023 and 2025 increased salaries of low-income workers due to inflation, and also introduced transport allowances due to fuel subsidy removal. Who then is a low-income worker? The law says that it's a worker whose gross monthly remuneration after the increase does not exceed 100,000 naira. Therefore, any additional award or salary increase to an employee earning above 100,000 naira monthly shall not qualify. Let's do a simple scenario using Excel. Let's say company B increases salary of 10 workers in 2024 and 2025. In 2024, 5 workers earning 65,000 naira per month increased to 80,000 naira per month, while in 2025, 5 workers earning 80,000 naira per month increased to 95,000 naira per month. Increase per worker is 15,000 naira per month for both years, and the annual increase per worker will now be 15,000 naira times 12, which is 12 months in a year, which is equals to 180,000 naira. Total annual increase, therefore, for 10 workers, 5 in 2024 and 5 in 2025, amounts to 180,000 naira times 10 of them, which is equals to 1.8 million naira. For the tax treatment, now we can see the effect for both companies. Even though both companies have the same turnover and the same expenses, we can see that company B has the compensation relief, thereby leaving it with a lower taxable profit and a lower tax expense when compared to company A. This compensation applies to only companies, right, and not to the individual that is being paid. Another newly introduced relief is what is called employment relief, being 50% deduction for salaries of new employees hired and retained for at least 3 years. Again, the B part of section 163 subsection 3 better explains this. It says salaries of any new employee constituting a net increase in the average number of new employees hired in 2023 and 2024 calendar years over and above the average net employment in the 3 preceding years, provided that such new employees are not involuntarily disengaged within a period of 3 years post-employment. In this section, net employment means the total number of persons employed less the total number of persons disengaged during the calendar year, whether such person is disengaged voluntarily or not. What this is saying is that if the average number of new staff a company hires in 2023 and 2024 is greater than the average net employment in the 3 years preceding, whereby net employment means number of employed staff minus number of exited staff, then the company is entitled to an employment relief, which is 50% deduction of the salaries of those staff who made up the net increase, provided that those staff have stayed with the company for at least 3 years. Moving on, there will be tax holiday for the first 5 years for agricultural businesses. Also, gains from investment in a labeled startup by venture capitalists, private equity fund, accelerators or incubators are also tax-free. If you are a small company, you would also be exempted from the 4% development levy. The exemptions under the withholding tax and the value-added tax sections will be explained when I do their own videos. Under the stamp duties section, Electronic money transfers below 10,000 naira will not be taxed. Salary payments, intra-bank transfers, which are transfers done from one account to another within the same bank, transfers of government securities or shares, and all documents for transfer of stocks and shares will also not be taxed under the stamp duties section. Now, you already know that as a retiree who is receiving your retirement benefit, that benefit that you are being paid is tax-free. Or if you're an individual that earns less than the national minimum wage, you also are not expected to pay tax on that amount. Or you're probably a small business owner whose turnover is less than 100 million naira and total fixed assets is less than 250 million naira. Now you know that you're also exempted from paying tax. Or maybe you're someone who has just lost his job and is being given a severance package, a redundancy benefit, or a termination benefit, or any form of compensation for loss of office. Now you know that the first 50 million naira of that benefit will not be taxed. Having a proper understanding of these reliefs and exemptions will properly guide you as we enter into this new tax season. So I'll be stopping here for now. I hope you enjoyed these videos. If you have any questions, please drop it in the comment section and I'll be glad to answer all of it. Don't forget to subscribe, like, and share this video. Like I said in my previous video, I'll be doing more videos on several topics relating to these tax laws, so please remember to hit the notification button so that you'll be notified as soon as these videos are uploaded for you to stay updated. Thank you for watching. I'll see you in other videos. Bye for now.